Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, March 19th. Nvidia unveiled new products and partnerships at its annual technology conference yesterday, but investors' real cheer came from Germany, passing a bill to unlock hundreds of billions of euro worth of debt finance infrastructure and defense spending. Now, the US Federal Reserve's latest decision, its latest dot plot and economic projections are on deck today. Will a show of support from the Fed be enough to reverse the S&P 500's losses? I guess we're about to find out. So yesterday's normally appetite and price supportive news couldn't get the traction that they would a year ago. Yes, I am talking about Nvidia and Nvidia's reveal of its new products, where the company's CEO Jensen Huang took stage at the company's annual GPI Technology Conference at San Jose, and he actually showed off its new AI system, Vera Rubin, called after nothing less than the astronomer who actually discovered the evidence of dark matter. And Jensen Huang also announced new partnerships with GM and Taco Bell. The new Vera Rubin, the next generation chip, is apparently more than twice as fast as its predecessor Blackwell, and GM will integrate Nvidia's technology into its self-driving cars in the future and will also benefit from their AI systems for improving the performance of its factories and its robots, while Yum Brands is also looking to boost its own AI-powered drive-through ordering. Now, just a year ago or 2 years ago, investors would be popping champagnes to find out about the new and faster chips from Nvidia and the real-world partnerships with the technology and the non-technology names, but this time around they just weren't impressed. So not impressed that the stock price fell 3.43% yesterday. Now, of course, it was not about Nvidia or AI or appetite for AI, right? It was mostly about the overall market mood that's been souring since a while now due to a number of reasons, including the tariff war, the high big technology valuations, the rotation trade toward the non-technology and non-US names, the uncertain Fed outlook, and the ugly geopolitics. As such, the S&P 500 reversed 2 session gains yesterday and fell 1%. Nasdaq 100 lost 1.66%, and the Dow Jones Industrial Index eased 0.62%. Facebook became the last of the Magnificent Seven stocks to give back all of its year-to-date gains. So voila. If Nvidia's AI news couldn't whet investors' appetite yesterday, it really means that the correction that we see in US equities is actually poised to extend a bit deeper. And we could see an additional 5 to 10% sell-off in the S&P 500 from the actual levels. Now, for the short-term investors, there could actually be a tactical opportunity in the US equity sell-off. And for the long-term investors, well, the periods of correction, of market correction, are not particularly enjoyable because the sell-off happens fast, but there has always been light at the end of the tunnel. That's the good news, because according to data shared by Covenant Wealth Advisors, a correction of the S&P 500 takes around 5 months to mature from peak to the bottom. Then you count for 4 more months to bounce back, and on average between 1997 and 2020, the S&P 500 stocks were up by 32% a year after a correction. And there is one more bright spot in all this, in this red market trend, and it is that the higher volatility that we see in the stock markets and increased moves in the stock trading are boosting revenues in the big banks trading desk and JPM. So JP Morgan is apparently on track for a 30% rise in the stock trading revenue this quarter. So not everybody is sad about what's happening in the US right now. And also across the Atlantic Ocean, the spring winds are gently blowing across the markets, as you know. So the Germans agreed to pass a bill that will allow the German government to increase its spending without being laid back by the strict borrowing rules of Germany. And Germany could, in this context, borrow up to 500 billion euro for a special off-budget fund to finance infrastructure and defense needs. Isn't that great news? And obviously, the other European nations will feel free and more comfy to do the same in the foreseeable future. So the defense stocks cheered the news yesterday. Rheinmetall jumped more than 5.5%. The BAE Systems added more than 1%. The select Stoxx 600 Europe Aerospace and Defense ETF that actually includes these names among other defense names in Europe gained another 1.46%, and the Stoxx 600 index was up by 0.61% in a continued contrast with the American peers' morose market performances. And cherry on top, the German 10-year yield eased yesterday despite the news, as the German government's intention to boost its spending was fully priced in by investors, and the euro-dollar traded above the 109.50 level. Now, the traders are now shifting their focus to today's Federal Reserve meeting to find out whether the Fed could and will do something to reverse the negativeness that we see among the US market investors since the start of this year. So the Federal Reserve is expected to maintain its interest rates and its policy unchanged at this week's monetary policy meeting, but it will update its dot plot, its growth and inflation projections, and will give a hint to the market and investors regarding where it will be putting pressure in this changing economic and geopolitical landscape. Is the Fed worried about a renewed uptick in US inflation due to the government's hectic tariff policies? Is it more worried actually about the negative impact of the wide-ranging White House policies on US employment and US growth? Is it more worried about the stock market sell-off? What is the Fed worried about? Now, what investors are explicitly wishing for is to hear that Jerome Powell and his peers are ready to step in case the market sell-off gets worse, to ensure a minimum financial stability in the market, a thing that the Fed has beautifully done in the past, remember, by lowering the interest rates and buying bonds. So economists now expect the Fed to cut the interest rates 2 times this year as a response to the economic slowdown in the US, but with a limited progress toward the 2% inflation target. And traders see 3 interest rate cuts as a response to potentially ugly sell-off in equity markets. But either way, activity on Fed funds futures hints at around 65% chance for the next rate cut to arrive in June from the Fed. Now, the dot plot will tell who is closer to Fed's mind and when we could actually expect the next rate cut from the Federal Reserve. Now, a dovish stance from the Fed today could help slow the equity sell-off and give a minor rebound to US equities, while a cautious stance from the Fed could send the S&P 500 back into the correction territory, meaning 10% or more lower than its February all-time high level, and extend the scope for a deeper correction in the S&P 500 and other major US indices. Now, in the bonds market, the US 2-year yield is hovering around the 4% mark this morning. The US 10-year yield sits near the 4.30% level. The US dollar index remains under the pressure of the waning growth prospects for the US economy, and the euro-dollar bulls are waiting in ambush to push the pair above the 110 psychological level. And note that, yesterday's phone conversation between Donald Trump and Vladimir Putin didn't really hint at a sustainable peace anytime soon in Ukraine, but the Russians agreed not to bomb the Ukrainian energy infrastructure for a month. So crude is extending losses this morning below the $67 per barrel level. The candlesticks of the past days have long upper wicks, mind you, hinting at a clear lack of conviction from the price rebounds that actually suggests that the bearish trend in oil remains strong in the short run, and we could see further losses accumulate toward the $65 per barrel mark. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope This episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, and on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow after the Fed decision, and until then, good day trading.